Chapter 6. Analysis of financial statements. Now that we know which are the two primary financial statements for the company, we can go a step further and analyze in more detail the current financial status of the company by reviewing the statements that we already know. For example, we can take a look at the balance sheet as well as the income statement of the construction company. However, these two statements give us a lot of information in terms of dollars and cents, and we already know that the balance sheet will give us the total assets as well as the total liabilities of the company, including the equity. The income statement will give us the total revenues and the total expenses, which include construction costs and equipment costs. We can go a step further and take a look at in more detail about the financial status of the company by reviewing the financial ratios. The financial ratios are numerical values that are expressed either in decimal format or in percentage format based on certain calculations from figures that come directly from the income statement as well as the balance sheet. We have several types of financial ratios. For example, we have the quick ratio, and that is the formula that you will use to calculate the quick ratio. We have the current ratio, which equals the current assets divided by the current liabilities. And we have other ratios that are indicated on the textbook. And pretty much they're all self-explanatory. Just make sure that you include the data from either the income statement or the balance sheet. We have the debt to equity ratio, fixed assets to net worth ratio. We have the current assets to total asset ratio. Again, that ratio is determined from information on the balance sheet, current assets divided by the total assets of the company. The collection period. Basically, the collection period is measured in days, and that indicates how frequent the company is collecting its payments from vendors or actually from customers or clients. The collection period is equal to the total accounts receivable multiplied times 365 days divided by the revenues. The ideal is less than 45 days. A company that has a collection period over 45 days may indicate some signs of trouble that they are having a hard time collecting their money. The average age of accounts payable, this measures the frequency of how soon the company pays its debts, and that is measured based on the accounts payable multiplied times 365 and divided by the materials and subcontract amounts. Again, the ideal time period is 45 days. Anything above that would give some indication that the company is late in making payments, and therefore that may have a consequence to their credit worthiness. Another type of ratio, the assets to revenue ratio. Working capital turns. This measures how efficiently the company measures its working capital, or how efficiently the company is using its working capital. The gross profit margin. This is a very important type of information. This indicates the gross profit margin for a company Essentially, it measures or it's calculated knowing the gross profit of the company divided by the revenues. If you recall, the gross profit of the company is measured or is calculated based on the total revenues minus the total construction expenses. The general overhead ratio. Another important gauge for the company, because this allows the management to determine how much money and what percentage of their overhead is being used. The general overhead is calculated by dividing the total general overhead amount to the revenue. Ideally, a company should be operating with no more than a 10% overhead. If you recall, the overhead is calculated based on information that's gathered on the income statement. And when we're talking about overhead, this refers to the company overhead. These are the administrative expenses that are incurred by the company for salaries, rent or mortgage payments, insurance, all those expenses, utilities that would be paid by the main or general office. The profit margin can also be calculated, not to be confused with the gross profit margin. This is actually the profit margin and can be established before payment of taxes or after payment of taxes. And the formula is shown here. Return on assets, another type of ratio. Return on equity, an important ratio because this allows the company to inform their shareholders on what kind of return they're getting on their investment. Ideally, the after-tax return of equity should be at least 15%. This is, for example, money that the investors will put into a company where they would anticipate to get a return of 15% of their investments. So these can be measured by doing this calculation. These are other degree of fixed asset newness is the measurement of how new a company's assets are. And compared to other companies or compared to the industry averages, that should be between 60 and 40%. Months in backlog, that can be calculated. In other words, is a measurement of how much work is in the pipeline, how much work the company anticipates to obtain for the next 12 months. And that's calculated based on anticipated work multiplied times 12 divided by the revenues for the last 12 months. This concludes Chapter 6, Analysis of Financial Statements.